NYSE, Euronext, and the Intercontinental Exchange, better known as ICE, have announced that they are joining forces in a deal worth $8.2 billion in cash and stock. Let's toss it right over to Maggie Lake in New York with the latest. Maggie, what does all this mean?
Yeah, Ali, I think the real meaning is probably mostly symbolic for a lot of us ordinary investors out there. I do want to mention right from the top, though, that price tag is a premium of 38% for the New York Stock Exchange. So you imagine that there are some pretty good feelings down there on the floor itself. But listen, ICE, for people who aren't familiar with it, has only been around for 12 years, a little more than a decade. And they're buying a company that has really become the symbol of American capitalism, of modern capitalism. When you say stock trading, you think of the pictures we're seeing right there, the floor of the New York Stock Exchange. But times have been changing, and this is really sort of the underscore exclamation point on that. Between technology, the growth of derivatives and other types of products, a lot of the action has been moving away from the floor of the New York Stock Exchange, and we could see that when we go down there. I mean, from when I began reporting, you couldn't move. There was paper everywhere. It was a mob scene, and now there's a little activity at the beginning and the end, and it's mostly all done on computers. So that's really why the New York Stock Exchange is taking this step. This is a way to sort of, as they said in the statement with the merger, really leverage their iconic brand, and it still is a powerful brand, and give them exposure and the capital they need to keep up. What's in it for ICE? They get exposure to the stock derivatives part of it, the stock futures part of it. They mostly are, their business is centered in commodities and energy. And remember, this isn't the first time that they've wanted the NYSE. They've had it in their sights. They tried to team up with NASDAQ and do a hostile bid and push away Deutsche Börse when they were going after the New York Stock Exchange. But regulators were concerned about antitrust. In this case, because they're going it alone with the bid and they don't cross over in that area of stock futures trading, people seem to think that the regulators are going to greenlight it, Ali.
Yeah, the advantage, if you're not a shareholder, if you are a shareholder of the New York Stock Exchange, in pre-market trading, the stock's up over 38% right now. If you're not a trader, the main advantage to this will be for institutions, people who trade very, very heavily, market makers, things like that, because there'll be market efficiencies and price efficiencies.
Yeah, one would assume. I mean, that's the hope with any merger, right? But there's no reason to think that won't happen. One of the interesting things is whether those institutions will continue to put business this way. I mean, the other backdrop we're talking about here, I mentioned those big sort of industry changes of technology and the growth in derivatives business. But there's also been, because of technology, the ability for a lot of firms to use their own systems, all these other platforms, what people call dark pools. Those have grown a lot. So, for these public exchanges, it's going to be tough for them to keep up and keep a piece of that business. People feel really divided about that. Is that a good development for the markets? The exchanges would argue there's a lot less transparency when you're trading through those other vehicles. But, you talk to high-frequency traders, you talk to all sorts of people, and they say, listen, technology's here. You can't turn back the clock. We're just going to have to learn to deal with it. So it's going to be interesting. But you're right. From the bottom line for institutions, you'd hope to see a little bit more efficiency and, frankly, access to markets that maybe, you would have had to use several providers to get to.